This is William Jefferson Black, the publisher of Transaction Advisors. We're on the sidelines of the Chicago M&A conference talking with Rick Climan, partner at Hogan Lovells in Silicon Valley.
15 years ago, deal point studies really didn't exist. In the early 2000s, we started to see deal point studies come into their own. And various organizations, including the American Bar Association's M&A committee, of which I was the chair in the mid-2000s, started to collect data on deals that were done both in the private company arena and in the public company arena. And these deal point studies relied on publicly available agreements as their sample sets, so that they would collect agreements that were filed with the SEC. And that's by no means a full universe of agreements, because many agreements that are done, particularly in the acquisition of private companies, many of those agreements don't get filed with the SEC. So it was a limited sample set. But these deal point studies would look at various negotiating points that were controversial in the negotiation of these deals, and they would attempt to measure how often the buyer won these points and how often sellers won these points. And in that sense, they purported to define market practice. So they purported to answer the age-old question of what's market for particular provisions in acquisition agreements. This is the new generation of deal point studies. I think it was widely recognized that the earlier generation of deal point studies had two potential flaws. Potential flaw number one is that their sample sets were skewed simply because they only had access to publicly available data. And the problem is that a lot of the deals don't get disclosed to the SEC. And the reason they don't get disclosed to the SEC, at least when you're talking about acquisitions of privately held companies, is that no one's required to file those agreements or to disclose those deals with the SEC unless they're material to the buyer. And when you have huge buyers with market caps above $100 billion, for example, almost any deal involving the acquisition of a private company isn't going to be material. So as a result, the sample sets for these deal point studies included, for the most part, deals with relatively small buyers, where the deals were material enough to the buyer to require filing under the SEC disclosure standards. You could have a very large buyer buying a relatively small privately held company, and you could have a relatively small buyer buying a relatively large privately held company. And these earlier deal point studies treated those all the same. They lumped them together and looked at a single market. Those of us who've been doing this a while know that that market is not a single market. It's actually multiple markets. And the kinds of terms, the kinds of provisions that big buyers get when they're buying companies that are a lot smaller are very different from the kinds of terms that smaller buyers get when they're buying bigger companies. That's what led to the development of a metric that we called buyer power ratio, or BPR. And buyer power ratio is essentially the ratio of the size of the buyer to the size of the company being acquired, the target company. And we measure the size of the buyer, a publicly traded buyer, by its market capitalization. And we measure the size of the company it's buying by the purchase price that it's paying to buy it. And that ratio tends to correlate with negotiating leverage. A big buyer buying a small company in a deal that has a very high buyer power ratio is going to have a lot more negotiating leverage and is going to be able to extract a lot more buyer favorable terms than a smaller buyer buying a big company in a deal that has a relatively low buyer power ratio. And that's really the basis for this new buyer power ratio study that we just introduced in July. So one term that comes to mind is what we refer to as the full disclosure representation, or the so-called 10b-5 representation. This is a very powerful representation. It's a very broad representation where the target company and its stockholders basically represent to the buyer that in addition to the 20 pages of representations and warranties about the target company's business, and all aspects of its operations. They represent that there's no other information that's material beyond what's been disclosed in response to those other 20 pages of representations and warranties. It's sort of a catch-all representation. And with the benefit of hindsight, some would say it really enables the buyer to almost always find something that the target company didn't disclose and should have disclosed in response to this very broad representation. So when you look at the historical deal point studies, the earlier generation of deal point studies, what you find is that today, looking at the entire marketplace as a single market and using the skewed sample set that those earlier deal point studies use, that the 10b5 representation appears in somewhere in the neighborhood of, say, 35%, somewhere between 30 and 40% of the deals, in a minority of the deals. So one might conclude that in today's marketplace, 10b5 representations are not market for these types of deals. And again, the types of deals we're talking about here are acquisitions by publicly traded acquirers of privately held companies. In fact, when you start to break the market down into separate markets, and you look at the buyers with the most leverage, the biggest buyers buying smaller companies, the statistics shift completely. And you see that 10b5 representations appear in well over half of the deals. So at least for that sub-market, deals with high buyer power ratios in the neighborhood of, say, 400 or higher, you're going to have a situation where a 10b5 representation is market. So one of the requests that sellers' lawyers typically make when they're negotiating an acquisition agreement in the situation where the sellers are shareholders of a privately held target, they try to limit the scope of the damages that the buyer can obtain if it turns out that some of the representations and warranties that they have made are breached. One of the ways they try to limit the scope of the buyer's recovery is to exclude the buyer's right to recover consequential damages. They actually define the category of damages that can be recovered as specifically excluding consequential damages. Consequential damages is sort of a legal term, and some people use it to refer to indirect damages or damages that are not a direct consequence of the breach of the representations and warranties. That's not a purely accurate definition, but for present purposes, that will suffice to demonstrate that a buyer that gets to recover consequential damages can recover a lot more in some circumstances than a buyer that doesn't get to recover consequential damages. If you looked at the historical deal point studies, the earlier generation of deal point studies, you saw that sellers were successful in getting consequential damages excluded from recoverable damages about half the time. But again, if you zero in on the market that includes deals with the highest buyer power ratios, situations where you have the biggest buyers buying relatively small companies, that statistic changes. And you find that in a very, very high majority of cases, there is no exclusion for consequential damages. So while sellers might argue, looking at the historical studies, that an exclusion for consequential damages recoveries is market, certainly if you're dealing with the sub-market that involves the biggest buyers and the deals with the highest buyer power ratios, you come to the conclusion that that provision is not market. So I tend to represent a lot of the big serial acquirers in Silicon Valley and outside of Silicon Valley in the technology sector. And not surprisingly, it was these buyers that were complaining, and in some cases complaining very vociferously, about those old deal point studies. So that had a lot to do with the coming together, with the genesis of this buyer power ratio deal point study. The technology marketplace has changed significantly over the years that I've been practicing. At the very beginning of my practice, which is decades ago, for example, private equity buyers were not interested in technology companies for a variety of reasons. One, private equity buyers rely so much on stable cash flow to service debt, and in the early days of the technology sector, or the earlier days of the technology sector, it was very, very difficult to find technology companies with stable cash flow. The technology sector was cowboy country, and many of the companies didn't have any cash flow at all, and their revenues were very irregular as well. That's changed, and that's been accommodating to private equity. The other thing that's changed is that private equity firms originally, because they rely on leverage so much, on debt, and securing that debt with security interests, they were initially somewhat reluctant to take security interests or to be comfortable with security interests in something as amorphous as software, these soft technology assets. I think as the sector has matured and the companies have grown more stable, I think buyers have also grown a lot more comfortable with the notion that technology is a valuable asset and that you can take security interests in this valuable asset if you proceed correctly. So that's one change I've seen in the technology sector. The other change I've seen in the M&A arena in the technology sector is the universe of buyers that are buying technology companies. It used to be the case that technology companies stayed within industry subsectors, industry verticals. Software companies bought other software companies. Hardware companies bought other hardware companies. E-commerce companies bought other e-commerce companies. Now everybody is playing in everybody else's sandbox, and those industry verticals have all but disappeared. And if you run a process that looks to strategic buyers as potential buyers of a target company, you may see hardware companies, software companies, e-commerce companies, social network companies, every kind of company in the running for that. The other related development is that technology companies are no longer bought only by other technology companies. There are new categories of buyers. To be sure, technology companies and the big serial acquirers that I tend to represent are still major players, obviously, in the technology marketplace. Private equity buyers, as I mentioned, are now in the mix. But another category of buyers that's been coming into the mix is old economy companies that realize that to drive growth, they have to look at technology solutions and they have to buy technology companies. We've seen this with the auto companies, we've seen this with the retail companies, and we can continue to see it with more categories of sort of brick and mortar or old economy companies. So that's changed the landscape quite a bit as well, William.
Thank you so much, Rick, for joining us. We appreciate the insights on what's happening in the M&A market in Silicon Valley and also some of the insights that have come out of the latest Deal Point study.